Mr. Vellayan Subbiah is Managing Director with Cholamandalam Investment and Finance Company Limited. That's basically the financial services arm of the Murugappa Group. Mr. Subbiah, thanks very much for coming on. As always, after the quarterly numbers. Good morning, Prashant this side. Could you describe the quarter for us, sir? As you saw it, I've got the numbers: net interest income growth of 25%, profit growth of 20%.
Yeah, Prashant, thanks. I think that compared to what we've seen in the past, it's definitely been a better quarter. For the first time, we've seen a slight improvement in collections performance. We'd like to see that be more sustained, so to really kind of give us the belief that it's real and it's here to stay. But it's been good because that's helped. In between that and the slightly lower cost of funds and better collections performance, it's helped push our profits up 21%. We still continue to take a cautious approach on disbursements. So disbursements are down for commercial vehicles quarter compared to the comparable quarter last year. But that's intentional, and we probably continue to take that stance till we see a lot more comfort on the collection side and real pickup in demand from the consumption side.
Could you break down the net interest income for us with a bit more detail? I mean, where did growth come from?
Net income margins, you mean, or so basically, where our growth is coming? The two or three biggest drivers for growth. First off, the two biggest drivers are improved collections performance and a slightly lower cost of funds. But we have been quite focused on the collection side, and I definitely believe that that is the largest driver for this. It's beginning to yield a lot more in terms of results for us.
Right. So when you say collections, you mean recoveries, right? So essentially there would be some sort of interest as well, which you would have collected.
That's right.
And right. So would you say for the third quarter that was basically primarily the reason for the growth?
Yeah, that and the lower cost of funds. Those two.
That and the lower cost of funds. Okay, and you said loan growth, you remain, in terms of disbursements, you remain cautious. Overall loan growth was about 1% quarter on quarter. Could you break it down in terms of segments?
Sure. So you take commercial vehicles, for example, we disbursed 2,290 crores versus 2,587 crores in the same quarter last year. So we were actually down about 8%. And in home equity, we disbursed 754 crores versus 688 crores in the same quarter last year. So that was a growth. And so, we've had the two pretty much offset each other for a fairly flat quarter. So 14% growth on one side, but kind of overall our growth has been about negative 8% in terms of disbursement.
What about SME loans, etc.?
So SME loans predominantly for us fall under the loan against property segment. We also do some independent SME, but that book is much smaller. So we have about a 6,000 crore loan against property book and about a 400 crore SME book. Okay, you said cost of funds was another reason, right? Why the numbers, you've shown the numbers that you have. Could you talk a little bit about that? What is the sort of borrowing profile now? How is it changing at Cholamandalam? Yeah, so the good thing is that after the reduction in rates from RBI, we've had a couple of banks follow, though that is obviously not impacted last quarter's performance. That will begin to impact for the future. The other thing is that we have moved a bit more away from, our mix has moved slightly away from banks towards more NCDs and CPs, commercial paper and debentures. And those are definitely pricing at lower rates than bank term loans at this point in time.
Okay. No, you're moving toward, you're basically moving away from bank funding. Is that what you're saying?
Yes, I would say that we've shifted our mix more towards NCDs and CPs at this stage. Yes, but we have therefore reduced bank funding in the last quarter, yes. Right.
Sir, would you, is there anything on the horizon which indicates, any sort of turnaround in the underlying business and we're able to forecast some sort of growth coming back in your businesses? Is there anything out there? The sentiment remains quite bullish.
Yeah.
But that's mostly still talk. On the ground, are you seeing anything at all?
Yeah. So Prashant, like I've always said, I mean, to me, the lead indicator of things getting better is improved collections performance. So if you look at our portfolio, at least we've seen that for the last couple of months, which I'm encouraged by. I feel, if you have 5 or 6 months of improved collections performance, then naturally demand will pick up. Now, obviously, the big question in our industry is, once demand picks up, how much of that demand will be met by, the existing, what I call hangover supply, which is, repossessed vehicles. And repossessed vehicles will be fixing that demand-supply gap in the near term. So first off, I'd like to see a couple more months of improved collections performance. Then I think we'll see a couple months or, maybe even a bit longer of, the demand-supply gap being fixed by, the gap or by the oversupply of repo assets in the market. And then I think you'll begin to see some real demand growth. So I don't think it's immediate, but, green shoots are already there in terms of the heavy commercial business, which has seen a significant increase. Because that business has now been down for 3 years, and now we finally begin to see light at the end of the tunnel there. So I do believe that it is going to get better, but it's not going to be at any significantly accelerated pace.
Okay, but the one thing that you pointed out is improving collections basically is one of the early indications, right? And a few quarters more of this points to better business environment overall. Just on the asset quality front, could you detail the numbers out for us? NPLs, for example, what happened?
Yeah, so sorry, do you ask about NCLs or NPAs?
NPLs.
Yeah, NPA, yeah. So NPA overall as a company, our GNPA is now at 2.8%, which is about 50% provided, so our net is about half of that. And for vehicle finance, it's at about 3.1%. Both are up from the last quarter. And, that is natural given the fact that, all of the 6 pre-NPA buckets for us had swelled fairly significantly over the last year. So even when performance begins to get a bit better, that is when roll forward rates start decreasing, you will see this natural increase for the first couple of quarters, and then it'll begin to flatten out and decrease. So hopefully that's the phase we're in. That's our belief, and we'll see that played out as the next couple of quarters evolve here.
Right. Could you explain that a little bit? As you said that even when you start to see recovery first, I mean NPLs start to increase and then flatten out and then decrease. How does it work in the cycle? Could you just explain that?
So actually we need a maths lesson in a board, Prashant, but I'll try my best over the telephone here. So the way it works is that you have think of it as a funnel, right? Which is when a customer doesn't pay you for the first month, then the customer moves into what's called the first bucket, right? And when they don't pay you for 6 months is when they move into NPA. Right, so you have a funnel where the largest is bucket 1, second largest is bucket 2, third largest is bucket 3, so on and so forth. Now, if that funnel used to have a diameter at the top of, I don't know, I mean, kind of, if you take kind of 100, a year ago, that diameter is now kind of, 200 or 300, right? So the whole funnel is a lot bigger. So even if you're letting very little from the 5th bucket into the 6th bucket, right, as a percentage, the amount that's actually rolling into NPA is fairly significant, right? Okay. And I know that's probably not a great explanation over the telephone, but basically, so it's what's called a roll forward. The roll forward rate means how many customers who are in your 5th bucket move to the next bucket. That means they don't pay you for another month, so they move to an NPA bucket for you, right? And you can say if 50% of your customers are flowing to the next bucket, then obviously you've got too many flowing. So you've got to bring that number down. So we've seen that number come down. The percentage that's flowing into the next bucket has come down. But because the diameter is so big, the GNPA will still go up as a percentage of your overall assets. And you have the second effect, which is the denominator is not growing because we've been more cautious on disbursements as well, right? So those two factors combined basically will make the GNPA go up even if the roll forward rate, which is an indication of your collections performance, improves. And then you basically have to look at the next step, which is as the roll forward rate improves more, then slowly, it's like the equivalent of your waist size beginning to shrink, right? So kind of then your waist size begins to shrink. So it's like, I guess that diet is a good analogy of it, right? Kind of, so then once the waist size begins to shrink, then overall you'll see the GNPA numbers come down. Okay, Prashant, I wasn't alluding to your waist size.
I think that was a great, sort of way to explain things. Where I completely got that. I hope our viewers did as well. Very interesting talking to you as always, Mr. Subbiah. Appreciate it very much, sir. Thanks for taking our call and speaking to us. Thank you. Okay, let's take a look at what the market is doing.